We start off in the U.S. markets where the markets closed mixed on Friday as data essentially pointed to a bit more progress on the inflation front. The Dow was up 0.33%, essentially closing at an all-time high during the session. However, the S&P and the Nasdaq lost 0.13% and 0.39% respectively. The major averages for the week, however, extended their gains for a third week, with the S&P and the Dow adding 0.6% each for the week, while the Nasdaq was up almost 1% for the week. The market received encouraging news on the inflation front as the Fed's preferred gauge for inflation, that's the personal consumption expenditure, printed in line with expectations, with a month-to-month increase of 0.1% and an annualized figure of 2.2% against an expectation of 2.3%. We also saw some macro data that provided some encouragement or continue to reflect really the resilience of the U.S. economy. Initial jobless claims fell more than expected in the latest reports, while the final reading for Q2 2024 GDP came in at 3% unrevised. We also saw consumer confidence data, which was sort of mixed, really. The Conference Board data showed its steepest month-on-month decline in 3 months. It dropped to 98.7, down from 105.6 in August. However, the University of Michigan consumer index number came in stronger. It rose to 70.1 in September from 67.9 that we had seen in the month of August. So essentially going into the rest of the week, we'll be looking out for more macro data. ISM manufacturing data is due out, initial jobless claims. There's also going to be quite some Fed speak through the week as well. So obviously we'll be listening to the Fed presidents, and trying to glean, their own thoughts around where interest rates should go and whether the Fed is on the right path, at this point in time. Also, another critical data point that will be coming out this week is the unemployment data, which we expect to come out on Friday. The median expectation is around 144,000 jobs will be created. The last number was about 142,000 jobs. So we'll certainly be looking out, for that number and see where it prints. It certainly is going to have an implication for the market because it will continue to give us a strong sense of how that labor market is holding up. Over in Europe, the Swiss National Bank implemented its third rate cut this year, essentially taking its benchmark rate to 1%. And this was largely, really expected. I mean, the SNB was the first major Western central bank that started to cut rates as far back as in March of this year. Again, I think the inflation situation in Switzerland has improved such that domestically inflation really remains, quite subdued, with the latest headline figure printing at 1.1%. Also, according to the Swiss National Bank, the reduction in inflationary pressure was a major consideration for them, entertaining further cuts, and then they believe that these further cuts are actually necessary in attaining, price stability over the medium term. China was very heavy in the news, last week as, it basically released a raft of, stimulus measures aimed at really, reviving, the flagging economy that has been dogged by all of the issues around, the property sector, the fact that, disinflationary pressures are also beginning to appear, on the horizon for China as well. So we had, quite a raft really of monetary policy measures aimed at really, ensuring that the economy starts to grow again. Because if you look at the growth target for this year, which is 5%, the last GDP number that came out was about 4.7%. So there are strong indications that, China might not meet that. If you also look at the last retail sales, industrial production, they all fell short of expectations. So these monetary policy easing moves are essentially targeted towards, helping China attain, that 5%, growth target. Amongst other things, it basically is proposing to reduce the reserve ratio for banks by 50 basis points. That is expected to free up about 1 trillion yuan. That should boost lending. The repo rates have been reduced. The medium-term repo rates have been reduced. Also, mortgage rates on existing mortgages is also going to be reduced. That is expected to impact about 50 million households. Also, the plan for that is to ensure that interest payments are then reduced by about 150 billion yuan a year, thereabouts. So all of these measures really are aimed at, basically stimulating, the economy really, and ensuring, helping China attain, that 5%, growth target. Amongst other things, it basically is proposing to reduce the reserve ratio for banks by 50 basis points. That is expected to free up about 1 trillion yuan. That should boost lending. The repo rates are being reduced. The medium-term repo rates are being reduced. Also, mortgage rates on existing mortgages is also going to be reduced. That is expected to impact about 50 million households. Also, the plan for that is to ensure that interest payments are then reduced by about 150 billion yuan a year, thereabouts. So all of these measures really are aimed at, basically stimulating, the economy really, and ensuring that deflationary issue is tackled head on. We're also expecting to see also some fiscal measures as well. The expectation is that China is going to raise about 2 trillion yuan in special purpose bonds, and about 1 trillion of that will go into consumer subsidies and also subsidizing, the purchase of replacements of business equipment, while the other 1 trillion will go towards local governments in helping to, assuage their debt issues. I mean, the debt for the local government continues to remain a huge challenge in China, and that debt burden is estimated anywhere around $13 trillion as we speak. So that's really, really huge. And I think part of the major challenge has been that, the growth in China has been largely investment led, and that breeds a lot of debt. So the authorities have been trying for the last couple of years to pivot that economy to a consumption-led one from an investment-led one, and things really haven't worked thus far. So the expectation or the hope is that with these monetary moves, coupled with the fiscal measures as well, consumption will become something that begins to drive growth even more. I mean, consumer spending only accounts for about 40% of GDP in China. If you compare that to the rest of the developed world, it's probably 20-25% lower than what you have in places like the US and Europe and so on and so forth. The expectation again is that these moves will probably add about 40 basis points to output growth, for 2024, and that with these moves, although coming late in the day, it is possible that 5% growth target can then actually be met. Over in the Middle East, tensions over the weekend really, really escalated between Israel and Hezbollah, which has seen the killing of, the leader of Hezbollah. This is a situation that we'll continue to monitor. Nevertheless, it's not had the sort of impact that we thought it would have on oil prices. But again, we will continue to watch that and see, because it has, potentials to drag and become a wider conflict that then involves directly countries like Iran and so on and so forth. So it is important to keep an eye on that, and we'll continue to, do that. Over in Nigeria, last week was a very, very interesting one. We had the MPC meeting where, the committee increased interest rates last week in a move that was somewhat surprising to a lot of market watchers and participants, particularly because we had seen a bit of progress, albeit, small, on the inflation front. So the expectation was that the committee was probably going to hold off and see how things pan out. Nevertheless, I think that the concern around core inflation and the fact that there are inflationary triggers down the road, the committee has decided to kind of be proactive and get in front of that inflation, threat. So we had a number of auctions last week. We had a treasury bill auction where, the stop rates were increased. The stop rate on the 90-day paper increased by 37 basis points to 17%. The stop rate on the 181-day paper increased by 50 basis points to 17.5%, while the stop rate for the 1-year paper increased by 141 basis points to 20%. So again, we saw an upward trend, in stop rates at the treasury bill auction, and this created a very, bearish sentiment in the markets, and we basically saw, investors looking to exit their positions to look at getting in on better yields that the market was beginning to show. So that was a major thing in the market as well. We had 2 OMO auctions last week as well. It was a case of the central bank trying to mop up the excess liquidity that we had seen in the system, but those OMO auctions closed really, really high, about 24% discount handle, seeing yields above 30%, which was really, really strong, and that had a very strong bearish impact on the treasury bills market. The bond market essentially had the same, bearish sentiment, just basically on the back of the outcome of the MPC meeting and also the OMO auctions that we had seen in the market. So sentiment was, largely bearish. I mean, coming into this week, we expect that things could just balance out, particularly as the fact that, that liquidity has been sort of brought under control by the Apex Bank. On the global front, we'll obviously keep an eye on, that macro data coming in from the US. We'll also keep an eye on, the Fed speak that's happening to glean any indications as to how the Fed is beginning to think about this and what path they are likely to take, going forward. So for the local market, we would certainly keep an eye on the liquidity situation, as that would, largely impact where we see fixed income yields going in the near term. And that's pretty much it in terms of our market update. We hope that you have a very, very productive week. Thank you very much.